Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. And in today's episode, in the first portion, I'll be covering whether or not Microsoft is a buy today. And then in the second portion, I'll be covering some other stocks that I view as attractive in today's market. So this is my Microsoft holding over here. It's currently around 6.2% of the entire stock portfolio, excluding cash. So it's still currently a tiny position, I would say, relative to other more riskier positions like, for example, ASML, Google. So I'm actually looking to increase my Microsoft allocation over time. I think it's a juggernaut that won't fail. So is it now time to buy Microsoft shares? So first of all, let's take a look at Microsoft's valuation. So this is Microsoft's PE over the past 10 years. It's the basis for valuation. And over here, as you can see, Microsoft's PE now is currently around its median over the past 10 years. So on a historical basis, the company is probably around fair value. And besides that, in the last earnings quarter, they actually had a one-time hit in terms of its earnings because of OpenAI losses. So OpenAI, as we all know, is burning a lot of cash. And what happened as a result of that was that Microsoft had to include that in their income statement as well, because they own around 30% of OpenAI. So this was a one-time expense. It is non-operating for the company. Of course, it's still part of the company because they own OpenAI. But they actually said that from next quarter onwards, they'll be removing these OpenAI losses. So that's why we're about to see a bump in terms of earnings. And these are some of the earnings forecast by your analyst. Next year, they're projecting around 19% increase in terms of EPS. The following year, 15%, and then the year after that, it's around 19% or so. So your analysts are quite bullish on the stock relative to your other Max 7 companies like Meta, Apple, Google, Tesla. Microsoft is actually the one that is forecasted to grow the fastest. I believe it's forecasted to grow even faster than Amazon as well. So for Microsoft today, this is just some napkin numbers for the company. So assuming a 15% growth rate for the company and assuming a 28 times multiple, which I think is reasonable given the qualities of the company, you will get around a 12% CAGR from this company at today's price of around $475 a share. So what you're getting with Microsoft today is a stable 12% returns at this price. I think Microsoft is currently trading at fair value, and I'm actually looking to increase my allocation for Microsoft over time. I might take some time to buy some shares, but it won't be anything aggressive because the company is still not extremely cheap yet. Next company that I think is interesting today is this company called Pinto. It's in China. It's a deep value company that is currently trading at around a 14 times of earnings. So maybe I can try and explain a bit more about Pinto's business first. So I'm sure we all know the three giants, the three e-commerce giants in China. You have JD, you have Alibaba, you have Pinto as well. These three companies are the major players in the space, along with Douyin and other video platforms also. So for Pinto, the business model is a bit different from Alibaba as well as JD. So Pinto, they target the lower end market. Alibaba as well as JD, they target the higher end market. And what differs in their business model as well is this thing over here, which is that Pinto does more of a consumer to manufacturer based business model. So what they do is they get from the manufacturer, they're the middleman, and they send it to the consumer. Whereas for Alibaba, they do more of a B2B to C business model. So you have a lot of middlemen in the middle, besides Alibaba, of course. So you have the distributor, you have the retailer, and then you have Alibaba, and then you have the consumer. So there's a lot of different people in the middle of the chain before it gets to the consumer. So what this allows Pinto to do is it allows them to make sure that cost is kept at the lowest point for everyone, because more often than not, your manufacturer will charge the lower cost. The markups only come when you have the distributors as well as the retailers in the middle of the block. And that is what Pinto does also. So Pinto is a company that is known to provide the cheapest option for all its consumers. And that is sort of like the brand image for the company right now. Okay, so Li Lu is a very respected investor. He recently added a quite sizable amount of his entire portfolio into Pinto. So as you can see over here, it's around 18% of his entire portfolio into Pinto. And that was what actually piqued my interest. And for Pinto, the reason why the stock is down is because of revenue growth prospects. So if you have to look at their last earnings quarter, this was their earnings report. So revenue only went up by around 9%. Operating profit, I believe, was up around 3%, and then the net income was up around 17% because of non-operating income from elsewhere. So I won't be getting into that, but the main point over here is that the markets are fearful. that Pinto is losing out on growth. Pinto is slowing in terms of growth because of intense competition, and you're seeing it in the top line revenue over here. So why exactly is the earnings down so much? Why is the cost going up faster than the actual revenue for this company? So if you actually look into the numbers over here, the reason why the income was actually lower in terms of growth as compared to the revenue is because of their R&D expenses. So what Pinto is doing is they're developing something else called Toto Grocery, something along the lines of that. Basically their grocery line, and what they're doing is they're spending money on fulfillment centers in that department because that department is growing quite rapidly. So it's growing at around 30% CAGR, the grocery segment of the business, and they're actually funneling a lot of their cash to that portion of the business. Besides that, the management have also said that they'll be spending a lot of money to make their merchants happy. So over here it says that, for example, under the CNY $100 billion support strategy, the company has launched several local specialty initiatives, helping high-quality agricultural merchants significantly expand the scale and efficiency of moving agricultural products online. So they put in, I believe, $10 billion a few years ago, like 2 years. And currently now they're looking to spend this $100 billion. I'm not too sure how long it's going to be spread out. Management hasn't said it yet, but they're spending this to make the merchants happy. So what exactly is the benefit of them spending all this money on the merchants? So in the short run, it will hurt the company's earnings, of course, because sales and marketing expenses will go up. But in the long run, this could actually be a good thing for the company because this allows Pinto to make sure that sellers can sell on their platform at the lowest possible price. So of course in China you have all the different e-commerce brands, you have Baba, JD and Pinto. If Pinto is able to provide the lowest cost for all the sellers, then naturally the sellers will come to Pinto. And what that does for Pinto is that it will allow the company to funnel all these sellers into the higher margin profile business, which is their ad division. So currently now Pinto has around 50% of their revenues coming in from the ads division. Another 50% is from commissions from their sellers. So the one that is a lot higher margin is of course the ad division. So if they're able to lower the merchant fees on the side, provide more support initiatives, provide more incentives for merchant, this side of the revenue, the 50% commissions, might come down. But what this will do is it will help to funnel all these merchants into spending more money on ads, which is a higher margin profile business for the company. So the management actually had a lot of different things to say on their earnings call. I think the recent earnings call was a telltale sign that they're more long-term forward-looking rather than short-term. They emphasized greatly on the need to achieve long-term shareholder value for the company, and I think it's a positive. And that's probably why Lilu actually looked into this company, and he put around 18% of his US portfolio in this company alone. The next portion, I'll be addressing some of the bear theses for Pinto, as well as why the company looks interesting today. So the first bear thesis for the company naturally will be that there's immense competition in China. So while that is true, Pinto is already the lowest cost provider, so they're already competitive in terms of pricing. The other competitors will have to come down to meet Pinto. So first of all is that they won't have to lower their prices as much as their competitors. Second of all is that Pinto is less reliant on the commissions portion of the business, which is attributed to your gross merchandise value, which is GMV. So even if prices fall, this 50% of the revenue, which is linked to your GMV portion, will be hurt. But majority of the net income is actually attributed by the advertising portion of the business. So even if this portion falls, majority of the net income comes from advertising anyway. So it doesn't really hurt the company as much as your other companies in the space like JD as well as Alibaba. So that naturally brings me to why exactly I'm interested in the company today. So if you were to look at the balance sheet for this company, this is their last earnings quarter's balance sheet. So cash and cash equivalents is around $12 billion USD. Short-term investments is around $46 billion USD. So if you were to add these two up together, it's around $59 billion of USD in terms of the cash as well as the cash equivalents. And if you were to compare this to the market cap of this company, they're basically around 1/3 of cash. So this is downside protection for the company. So at its current valuation today, if you were to calculate it based on an EV to free cash flow basis, the company is currently trading at a 6 times EV to free cash flow, which is quite cheap even if the growth were to stagnate for a few years. You don't need massive growth if the company is trading at an EV to free cash flow of around 6 times. So I think a possible thesis for this company would be that the company puts the cash to work, and if Li Lu is able to have a bit more influence on the board, then there could be some sort of a shareholder yield over the next few quarters, which could be a catalyst for the company, because now the markets are also pricing in the fact that your shareholders are not being rewarded by the management team because they haven't used their cash. They've been saying that the cash is used for working capital requirements, but their working capital requirements doesn't require $59 billion. So for Pinto, this is one of the catalysts for this company that you can look out for, which is that Li Lu could influence the board into having more shareholder-friendly measures, into buying back some shares, which will definitely push up the stock price over time. So overall for Pinto, I think it's a decent business that is trading at a very good price, and that is why the company looks interesting today. Okay, last company in this list here is one that I will go over very quickly. It's Mastercard. So Mastercard today is down another 2%, and year to date this stock is around flat. So it's up around 4%. Currently trading at a 35 times of earnings. And on a historical basis, this is actually one of the lowest points for this company. And for this company, I think the bear case scenario, the minimum case scenario would be around 10% EPS growth, which is attributed by around 3% inflation, around 3 to 4% of buybacks as well, shareholder yield. And so that's around 7% already. And you include some population growth and some increase in take rates, that's the 10% that you'll be getting for the company, without including the fact that more people are moving from cash to debit cards to credit cards, without including the tailwind that stable coins can bring to this company. So I think Mastercard at today's valuation is a company that is extremely interesting, which is why I added heavily to this position. And I'll be looking to continually add if this stock continually falls. Last portion of the video, I'll be covering Meta shares as well as the reason why the stock is up today. So Meta is up around 4% today, and year to date it's up around 11%. So the reason why Meta is up is because they're planning some cost cutting in their metaverse division. So metaverse is actually the portion of Meta that is weaker right now. It's the portion that they're losing money on. So the reason why Zuck is so obsessed with the metaverse is because he doesn't want to pay Apple as well as Google. He wants to create his own platform. He wants to create his own eyewear where it allows Meta to bypass Apple. So what they're doing over here is they're actually cutting some of the budget for this portion of the business, which is the portion that has been losing a lot of money, and this could be a bump up in terms of the EPS next year. So this helps to smooth out the spending in other divisions. So over here it says Zuck said at that time that the metaverse is the next frontier, just like social networking was when we got started. So the proposed cuts will likely include layoffs, according to Bloomberg, which said the cuts were part of budget planning for 2026. I think this is a good move by the management team to try and appease its shareholders, because your shareholders are clearly unhappy with the fact that Meta is spending a lot of money on AI as well as metaverse. So the cuts will likely hit the company's virtual reality group, which is your metaverse, and Meta declined to comment on the report. So I think this is positive for Meta. It will bump up their EPS. It will help to make sure that the company is at least able to grow its earnings in line with revenue next year, which is a sizable amount of bump up if they're able to cut this cost effectively. And for Meta, it's another example of the company's fundamentals growing and the stock price falling. So the earnings report came out in the last quarter, and what happened after that was the stock dropped around 20% after that. So it dropped down to, I believe, around $600 a share. From the lows, it's up around, I believe, 10%, 13%. So Meta is another stock, is similar to Google at that time, where the narrative was driving down the stock price, and now you're seeing the narrative flipping again. So this could be some sort of a starting point where Meta reverts back to the mean in terms of its valuation. I hope you guys have found this video useful. Feel free to check out our Substack and invest safe.